Hi everyone, I'm with ZCM Trading. I'm an independent market forecaster for myself. I do all my original work, and I'm a follower of Greg Mannarino, and I'm actually putting together this video exclusively for him and his viewers. Greg had paid me a compliment on some of my previous work and some of my forecasts, and he asked me if I could put together something for him just to give a different perspective, more on the technical analysis on the charting techniques that I do and how I interpret it, some forecasting. Again, being a follower of Greg, I follow different people. I get different opinions and perspectives. It helps me. I'm putting together this video for him and his followers, and hopefully you can use it for educational reasons and draw your own conclusions and do what you wish with it. Let's dive right in. This is the S&P 500. This is the SPY. Ticker symbol. I got this chart pulled up. As you can see, this yellow dotted line, this is just an uptrending trend line that has been going on for months, and we actually broke through it this summertime. If you remember, we had a little pullback this summertime, a little scare in the markets, and even though the markets managed to rally, we didn't really break back into it, so we kind of just ran up into it, came back down, and here we are today. This is on August 29th, 2017. So I fear that we've broken this trend line. Even though the market is struggling to go higher, we still broke this trend line at this point, which I don't really like. So I look at that as a bearish perspective on this. We can still go higher, though. You know, we can still keep climbing. We can stay below this broken trend line throughout this end of summer days into early fall. However, on a longer term chart, this may be a little extreme to some folks. It may seem unbelievable based on years and years of market just that keeps going up. This just doesn't want to come down. But the way I'm looking at this, we're having a tough time breaking through 2,500 on the S&P. I feel that this is really a strong ceiling right here at 2,500. I apologize for this pop-up. I think we're going to have a tough time breaking through this 2,500. I almost feel like I should call the top on this at this point. I just hate putting myself out there, but if I had to, I would say 2,500 is the top. Longer term, as you can see, if I really zoom out, the reason being is I feel as if we're going to revisit the 2007 bull runs that we peaked and had a recession. So this is 2000 that we peaked. We had a recession. We had a bull run. We had a recession. A bull run again. We broke through it in 2013 and we climbed along. So I have a feeling that we're going to revisit the 1600 level, revisit these peaks. Is it possible? Is it not? Of course, you know, it's up in the air. It's 2 years out, but I have a feeling, I don't know what the catalyst would be. I don't know what that flashpoint would be, but I have a feeling that should things get bad and the market break down, that would be the ultimate retest, okay? But instead of looking 2 years out where this could happen, you know, I'm looking at 2019 for this to happen, but I want to say 2200 in the S&P would be the first initial target to admire and see what happens at that point. But the rollover, if it should occur, which I'm expecting it to, would be into late fall. Again, it can happen earlier, but if we still stay strong, this market could eventually just roll over into late fall and just come down. Okay, and that's the S&P 500. Now on the next chart we have here, this is the QQQ. It's an ETF for the Nasdaq. It's the tech-heavy composite. On the Qs right here, and you're going to see a lot of these repeat patterns. I'm going to be talking a lot about the either double tops or head and shoulder patterns. I see a lot of that either happening, small patterns of it that repeat, and larger ones on full indexes. So that's a textbook topping pattern. I do see a lot of it in different charts and even in different indexes. So you got your left shoulder, your head, your right possible shoulder. Again, here we are today, end of August. If we zoom out and look at this, this could actually be a even larger head and shoulder top. This being the left shoulder, the head, and the possible right shoulder. So definitely looks possible. This is how I'm envisioning it. This correlates into the S&P 500 chart, which I mentioned before, into 2019 having a major sell-off. Okay. If you look at it on the grander scale from a distance, the way I'm zooming out, it just looks beautiful. I mean, you can just see it, the left shoulder, the head, and the right shoulder. Zooming out, you don't really see it too much, but you do see a little one based on the, let's try the daily chart. You'll see a more of a smaller version of it trying to play out. The left top head part and then the right shoulder. Okay, so that's the cues. All right, now I'm getting into some particular stocks. This is Disney. This chart here is a more of a shorter term. We got a left shoulder, we got the head and the right shoulder. And like I said before, you're going to keep seeing a lot of these patterns. Textbook topping pattern. Zooming out, you're going to see a double topping pattern. Okay, you got your first top and then your second top, which is lower. You got your descending channel. Obviously, this is a long-term perspective. This is going from 2015 to where we are today, so this takes time. But like I said, I dig deep into things, and I don't day trade. I look on a longer scale. The more data I have to back up things, the more solid and accurate the forecast is. Actually, what I'm going to do is zoom out even more on the weekly chart, and I got freaked out when I saw this because most people don't even go back this far looking at charts. But you're going to see something here where this is during the tech run of back in like 2000, 2001. If this pattern is almost identical to this pattern, so I have a feeling we're going to repeat what Disney did back in the tech boom and bust, not just by the pattern but also by this yellow dotted line which I used to match up the dates, and the time frame is actually almost identical, like even to the month. I'm not going to get into the exact months and dates, but this peak to this peak is basically this line. Okay, from bull run to sell off to bull run to sell off. It kind of matches up almost identical, even to the month, as far as even number of days and weeks to where we are right now. So when I look at that, it almost confirms to me that what's about to happen is going to happen. These green arrows is my projected long-term path, again going into 2019 for Disney. So you're going to see a lot of these repeat patterns going on. I'm kind of cherry picking a couple of things. I'm going after the low-hanging fruit. Not every stock in chart is equal, but like right now you have the retail sector being near its lows, and you have it underperforming the overall market. So you kind of just have to work with what you have and what you see. So right now Disney, I expect it to at some point get down to about in the 90, high 80 level at some point in the near future, and then longer term, I mean, there's really no limit at this point. We just have to wait and see. But my next target would be about 89, 90, and if that doesn't hold, then we can get back down into the the 60, even $50 range. But that's far out. I'm not thinking that far ahead yet. I just want to see Disney come down to about 90 at some point in the near future. I want to say I'm anticipating this fall into winter. And this is Home Depot. As you can see right here, 3 peaks and a domed house top. I'm kind of questioning myself because it hasn't played out yet, but You got 1, 2, and 3 as your three peaks and your possible domed house top. This is actually an infamous George Lindsay pattern. He was an old school technician from decades ago. Basically put together a pattern where pertaining to the industrial stocks, so the Dow Jones, and Home Depot happens to be in the Dow Jones, and it is an industrial-based stock, somewhat based on its industry that it's in. So I'm using that pattern and that analysis, and from what I can see so far. So I would expect it to obviously sell off. This is my little cone of uncertainty right here, the projected path of the decline. The reason why I'm using this cone is just because I really can't make out too much of a clear pattern or channeling that it's in. It seems to really have large swings, but the very end, I would assume that this red line would be the outcome that would confirm the domed house top. Okay, and I would expect it to hit about 120. That's my target price at some point. And also what gives me some weight is to this theory. We had earnings this summer. I think the numbers looked good. I mean, we're in somewhat of a housing recovery. You know, you have bidding wars and people buying and flipping homes like crazy and renovating homes and shopping at Home Depot. You would think with all that, Home Depot would rally and extend its run further, but it didn't manage to break at its all-time high right here after all of that, and it's been steadily declining in this little channel that I put in on this chart here. So it's slowly declining. It does have large swings, but ultimately I think that that red line or this cone would be the projected path for Home Depot. And speaking of retail stocks like Home Depot, let's get into Amazon. I know it's obviously a different type of company, but looking at Amazon, it's been nearly bulletproof, just steadily climbing in this nice incline channel. But there's something that sticks out to me right here. This candle with the long wick. I guess people call it the shooting star, doji, however you want to nickname certain candlestick patterns, but this really sticks out. Usually that's a reversal on a bull run or a topping pattern, but you got your left shoulder, your head, possible right shoulder. So we'll see what happens, but it's at a crucial point, 950 on the price of Amazon. So we'll see what it does. It's a make it or break it point right now. Again, going back to these head and shoulder patterns, I'm starting to see a lot of it. So if all these indexes break down in those topping patterns, I would assume, bulletproof Amazon might actually break through and actually get into the 800 range at some point. We'll see what happens, because right now, again, it's at a make it or break it point. If we rally in the next couple of weeks, possibly just kind of get an oversold bounce and then break through. I think that is most likely to happen, and it would actually complete this head and shoulders pattern. Really good, as you can see, looking at it. So can it break through the 950, this little channel that it's been bouncing off as a support? Sure it can. It would just basically slice right through and fall, but I suspect we're going to get a little bit of bounce in Amazon and then come back down. And this one, we're going to stick with the retail, but this is more of the restaurant sector. Again, if you look closely on this doji here, this Japanese candlestick, that shooting star, that nickname people give it there, that's usually with the long wick. That's just basically a buying and selling exhausting doji. Usually that's, again, a reversal pattern, but zooming out, the way I'm looking at this, I would expect some type of weakness. Support line is about 78, but I'd like to see this play out, or if not, we can actually extend this and pull this out a little bit here. But that's ticker symbol DRI, Darden Restaurant Group, which is one of the largest publicly traded restaurant. They own a lot of different restaurants under their umbrella, but it's difficult to say where this is going to be. It could be here. We could come down further and then rally, but I want to say on average this is what you're looking at for this particular stock. This to me is a really big red flag as a peak reversal on the price. I would expect some weakness, but $78 is about a support price, and if that doesn't hold, then this pattern will complete here. But definitely, I think we've seen the high for this stock this year, probably going up for the next year as well. And we're saving the best for last here. We got gold and we got rates coming up next. So this is gold. I made a prediction back last month that we would basically come down and rally through the summer, which we have. Now the thing with gold is I'm getting some mixed feelings at this point. You have your bullish breakout of this yellow wedge, which is this yellow line, which is this wedge that it's kind of been in for quite some time. So being that the fact that it broke out of it, it stuck its head out recently, I like that being bullish, but it's managing to stay in this red channel, these two red trend lines here. You got the support and the resistance, so it's managed to stay in and kind of in and out of it, but we're getting into overbought territory. This doji with the long wick, usually that's a sign of exhaustion, overbuying, and then the pressure of being sold. So I would not be surprised if we sell off or have a little pullback. It could get as low as 1265, 1270, and we can rally up, okay, and keep climbing along, maybe even retest the 1350, 1360 level, which was the last recent high we had back in 2016. So right now the path of least resistance, I want to say, is down for gold. I'm not ultimately bearish yet. I like to see this come down, get to 1265, 1275, and rally up, and then I can say, okay, 1360 would be the next target price on gold. But right now, you just be rolling the dice because it's stuck in between. You're about $50 to 1360, which is really strong resistance, and you're only about maybe $50 to get back down here. So again, you're kind of have a neutral stance on gold at this point. The one thing again that I don't like is this last doji we had. We just had this buying pressure and selling it back down, which I don't like. You don't really see it too often, and then when you do, I didn't mean to do that. When you do, it does mean sign of reversal. Let's get into rates for a moment. We'll finish it off here. Again, I apologize for these pop-ups. Everyone talks about the rates. You have Fed's talking policy. Everyone's about rates going up, rates are going down, rates are going nowhere, who knows, right? But I look at rates going back, far back, years and decades. They've been going down. This is the 10-year treasury. I mean, if you go back, way back into history, if you look at this, you can see that rates have just been going down on a perfect decline in a channel. I mean, this is really going back into time, but And not to bore you with years of history of what rates have been doing, but this ultimately tells me that rates are really not going to go up. There's no catalyst for rates to go up. I mean, there hasn't been a catalyst for 20, 30 years. So what would be the catalyst now at this point? And I wouldn't be surprised if we have negative rates in the future. I'm talking years to come. But here we are right here. Unless rates, unless the 10-year Treasury breaks out of 3%, which is right here, unless we kind of break out this way over 3%, I don't really see a confirmation of rates going up. There's more of confirmation of rates going down, because that's what it's been doing for the past 10, 20, 30 years. Rates have been going down. So there's my interpretation of the rate market right now and what to expect. So we'll see what the Fed does. I don't care. Like I said, I'm more of a technician perspective. I look at what I see in the charts. I don't pay attention to policymakers. I don't really want to put my faith in that. It's just you either follow that type of analysis and fundamental, or you look at the charts and study technical analysis, which kind of filters out everything else, and it's just all built into an image, which is what I follow. So again, rates down. I don't really care what the Feds do or say. Here we are today. So there you go. Again, I thank everyone for taking time and watching this. We've covered a lot. I appreciate Greg Mannarino's work. He voices his opinions to everybody, and I'm very honored to put this together for him and his viewers. This is my first video for Greg Mannarino, and hopefully in the future I'll be able to put together more items and work together for everyone to interpret and to hopefully learn something from it. Thank you.